They very well may be the safest possible investment, but are certificates of deposit something you should be putting your money into? Hello and welcome to Practical Personal Finance, where you get the information you need to understand and succeed with money. In the next few minutes, I'm going to tell you about what a certificate of deposit is and how it works on a fundamental level. Then I'll help you understand why banks offer certificates of deposit and why people purchase them. And finally, at the very end of this video, I'll give you my take on whether or not I believe certificates of deposit are a worthwhile investment. The answer involves a fundamental principle of investing, and it might surprise you. Let's start with the basics. A certificate of deposit, more commonly known as a CD, is a place where you can park your money so it can earn some interest while you're not using it. It's a lot like a savings account, but with two very important distinctions: the term and the interest rate. The term is the amount of time you're agreeing to leave your money parked in the account. You get to choose the term up front, and it can range from something short like 28 days to something much longer like 10 years. During that period of time, you will not be allowed to access the money you've deposited in the CD without incurring some form of financial penalty. More on that in a moment. Once the term ends though, you'll be able to withdraw your money free and clear. The interest rate is what determines how much you can expect to earn from depositing your money and agreeing to leave it alone for the term you select. The interest rate on a CD is typically higher than the interest rate on your everyday savings account. How much higher? It depends on the term you select and the amount you deposit. In general, a longer term and a larger deposit will result in a higher interest rate. The interest rate you see quoted on a CD is the rate of return you can expect to earn over a 12-month period. This can be a little confusing to some people, so here's an example. Let's say you deposit $1,000 into a CD with a 1-year term and a 2% interest rate. In 1 year, you will have earned $20 in interest. Pretty straightforward. But what if you were to deposit $1,000 into a CD with a 6-month term and a 2% interest rate? Because your money will only be in the CD for half a year, you'll only earn half of the interest you would earn in a full year. In this case, that equates to $10. What about if you deposited $1,000 into a CD with a 3-year term and a 2% interest rate? In this case, you'll earn 2% interest per year each year for the 3-year term, for a total of $60. When you're comparing rates and terms on CDs, keep in mind how both factor into your overall return on investment. Now, what would happen if you really needed to access the money you had parked in a CD before the end of the term? Can you do that? The good news is that yes, you can. But it's not all good news. Here's where those penalties I mentioned earlier start to come into play. If you want to withdraw your money before the term is up, you'll need to pay something called an early withdrawal penalty. These penalties will vary based on the financial institution you're dealing with, but they usually involve a percentage of the principal or original amount you deposited in the CD. As an example, let's say I had $1,000 in a CD with a 1-year term, but I needed the money for an emergency after just 6 months. My bank has an early withdrawal fee of 1%, so in this case I'd have to pay $10 to get my money out early. Sometimes early withdrawal fees also involve forfeiting some or all of the interest you've earned so far. My advice is to make sure you understand how this all works before you invest so that you don't have any surprises later. Next, I'm going to help you understand the why behind CDs. But before I do that, if you're getting some value out of this video so far, do me a huge favor and give it a thumbs up down below to let me know I'm doing a good job. Thanks. Alright, now that you understand the basics of how a CD works, I want to talk about why CDs even exist in the first place. And there are two sides to this equation. The first side is the bank. The way banks make money is by making loans to people and charging interest on those loans. The more money banks have access to in the first place, the more they can lend, and the more profits they can earn. So banks want to encourage account holders to deposit as much money as possible and let that money sit there for as long as possible. The certificate of deposit is a perfect tool to get that result. Customers deposit large sums of money and leave it alone for long periods of time. The bank is happy because now it's able to do more lending, charge more interest fees, and earn more profits. But what about customers who deposit money into CDs? They're the second side of this equation. What do they get from this deal? First and foremost, as I mentioned a few minutes ago, the interest rates on certificates of deposit tend to be higher than the interest rates on your normal everyday savings account. There's the incentive to put it in a CD. Furthermore, CDs tend to be federally insured by the FDIC if you're at a bank and by the NCUA if you're at a credit union. So there is virtually no chance that you'll ever lose money if you put it in a CD. You get an ultra-safe, ultra-secure investment with a predictable, consistent rate of return that you know in advance. That all sounds pretty great, and it brings me to my final question. Are CDs a worthwhile investment? As with many topics related to personal finance and investing, I believe it all depends on you and your personal situation. Everyone's a little bit different with how they handle money, and I'm not here to tell you whether or not you should put your money into a CD. That being said, here's one situation in which I believe a CD would be a great idea, one in which a CD could serve a useful purpose, and one in which a CD just doesn't make a whole lot of financial sense. Let's say you and your partner were saving a down payment to purchase a home. You had saved $25,000 and it was sitting in a savings account, ready for you to use at any time. But wait, you've got 7 months left on your apartment lease. You know for a fact you're not going to need that down payment until your lease is up, so why not put it into a 6-month CD? Your money can earn a little bit more interest while you wait, since you won't need access to it anyway. This is, in my opinion, the ideal use of a CD. You've got a bunch of cash you won't need access to for a specific period of time. With no risk and a modest return, you may even be able to net a couple $100s by the time you move. It's easy money, and it's yours for the taking. Would it be a good idea to stash all or part of an emergency fund in a CD? Maybe. Yes, you can earn a little bit more interest than if it was sitting in a savings account instead. But emergencies generally don't wait until your CD term is up. They're going to happen right in the middle of it, and in all likelihood, you'll be stuck paying an early withdrawal penalty to get your money out. For this reason, I wouldn't put my emergency fund in a CD. But maybe you're the type of person who has a hard time with unnecessary spending. An early withdrawal penalty on a CD might give you the nudge you need to leave your emergency fund alone, except in the case of a real, bona fide emergency. I don't see an issue using one in that sort of situation where you need to deter yourself from spending. What if you were trying to invest your money so that it could grow over several decades for you to use when you retire? In this case, I would argue that a certificate of deposit would be a poor choice of investment. First of all, the amount of interest you earn on a CD is often less than the rate of inflation. So while your money is earning something, it's technically losing buying power every month it stays parked in a CD. Second, you could be earning a whole lot more elsewhere. Part of the reason has to do with the amount of risk you're assuming. When you're investing, the amount of risk you assume tends to be correlated with the potential for greater returns or profits. As I mentioned earlier, there's virtually no risk when you're investing in a certificate of deposit. So the rate of return is going to be minimal. On the flip side, if you're investing in stocks or bonds, there's risk involved. There are no guarantees. You could lose money, but you have the potential to earn much greater returns than you would with a certificate of deposit. Have you ever parked money in a CD? I would love to hear about your experiences in the comments. If you enjoyed this video, you'll almost certainly enjoy my video about money market accounts. Click right here to watch. And if you're not yet a PPF subscriber, click right here to hop on board. As always, thanks for watching. I'm Andrew Shear, and I'll see you next time.